Okay, welcome everyone. My name is Peter and I am a co-trainer with the Option Profit Formula Success Academy, and today in this video I want to cover selling puts. Now before I get started, I just want to cover a few things that everything I'm going to share with you today is for educational purposes only. This is not investment advice. Always consult a professional before you invest your real money, and please, please, please don't by any means take anything I'm going to show you today and go out and trade options with your real money. That would be reckless, and in most cases you would lose that money, okay? So covering that real quick. All right, so what are we going to talk about? We're going to talk about put selling. Now put selling is what many options traders and investors use as a way to generate a guaranteed monthly income. So we're going to cover that. The other thing we're going to cover is naked versus covered puts, because it's very important to understand the difference between the two and where you may be if you implement this strategy. The big thing we want to cover, and that's the point of this video, is the risks involved. This is something that many don't cover. They really glamorize the return on investment, and they really are trying to get you hooked based on that return on investment. And this isn't to criticize or critique other investors or the people that put out videos that do so, but what I want to do is I want to show you that yes, those hooks are real. You can make very large returns on options trading, but this is a big thing you need to focus on. And when you focus on risk first and income second, or profit second, you will do much better, I promise you. And then the last thing we're going to cover is premiums. So let's go ahead and jump right into it. First thing I want to talk about is understanding options. There's really two types of options. There's only two types of options. There's a put and a call. And the way you trade them is I put here 2 ways to implement. There's really 3 ways to implement this. The two ways, buying and selling, everyone knows you can buy an option or you can sell an option, but really the third way is a combination of the two, and I'm going to show you that today. There is a combination of the two. What we're covering is selling puts, but at the end, if you stick with me on this video, I'm going to show you a strategy that combines the buying and the selling aspect, and I think is a better strategy to selling puts, especially for income. But let's just cover really the first thing, rights versus obligations. Because if you're not familiar with options, if you're new to options, number one, you really shouldn't be looking at this strategy or really any strategy. You should be increasing your education on how options work, and you should take a basic options course, which I will leave in the description below, because my mentor is actually offering you a free basic options boot camp, and I'll leave that below. I'll talk a little bit at the end, but the bottom line is when you buy an option, it gives you rights. Anytime, whether you buy a call or a put, it gives you the right to buy or sell a stock or ETF at a specified price on or before a given date. It's in my opinion, it's the most powerful position to be in when it comes to options, because no one can tell you what to do. You have all the power. You go out, you buy the option, and now it's your rights to do whatever you want with that option. No one can tell you what to do. Conversely, when you sell an option, it obligates you. That's why I call option selling the weakest part. Does it mean you should stay away from option selling? That's not what I'm saying. I'm just saying it's not the most powerful position to be in. When you're obligated to do something, you're not in a position of power. The person in the position of power that has the right to make you do something, and that's the person that bought the option you sold. So that's very important for you to understand. When you sell puts for income, you can make great income. Just understand, anytime you sell an option, you sold it to someone else who bought it. And the person that bought it, they have all the rights. They own the power. You do not anymore. You're now obligated to that person. So just very important point to understand about option selling versus option buying. Now let's jump right into selling a put option. So when you sell a put option, you're obligated to now buy a stock at a specified price on or before the given date. Here's an interesting point. Most people don't tell you. They'll say you're going to get exercised if your option is in the money on expiration date. I'm here to tell you that you can be exercised at any given time because you are obligated to buy a stock on or before a given date. That means whoever has the other side of that contract can exercise that contract on expiration date, or they can exercise that contract 6 months before expiration date if that's the life of your term of your contract. So in other words, if you sell a put option that has a 6-month lifespan, they could exercise you tomorrow. That's an obligation you signed up for when you sold that option. So just understand that. So one of the big things is if you're obligated to buy a stock on or before a given date at a specified price and you're selling puts as an income strategy, the first question that comes into mind is, well, then what would be the best time for me to sell it? What would be the best time for me to implement this strategy? And we're going to go over that. When we jump into the trading platform, which we're going to do in a minute, we'll get on my computer, we'll jump into the trading platform, we'll look at different options chains, and we're going to cover my favorite stock, Apple, and I'll show you how all that works, okay? So now the last thing I really need to cover, and this is most important, we talked about it, was naked versus covered. And what does that mean? Well, if you're going to sell puts, then you need to know whether you're selling naked or covered. It's simple as this. If it's a naked sale of a put option, if you don't have the money to cover obligations. So in other words, let's say you sell a 115 Apple put option. Doesn't matter, let's not even worry about expiration date. You sold a 115 Apple put option. You're obligated to buy Apple at $115. And because each option represents 100 shares, that means you need $11,500 in your account. Excuse me. So if your account is $5,000, you're selling naked puts because you don't have the money to cover the cost of that transaction. Okay. Now, if you have a $20,000 account, you have $20,000 in your trading account and you sell one Apple 115 put option, then it's covered. It's covered by the cash that's already in your account. Okay. So that's the difference between naked and covered. We, in the Success Academy, we do not teach this. We teach covered. Always have the cash in your account to cover the transaction you're placing. And if you don't, then don't trade Apple. Go out and trade a stock that doesn't cost as much. Or what we always tell our students is save the money. Create your account to be able to trade Apple covered puts if that's what you want to do. Okay, now some of you may be asking, well, if I don't have enough in my account, how can I possibly sell a put on Apple if I only have $5,000? And that's what's called margin. In most cases, if you've set up an options trading account and you've set it up to like a level 2 or 3, then it's a margin account. And what a margin is, the easiest way to look at margin is a loan. You're taking out a loan from the broker. You don't have enough to cover that transaction, so they're using margin to cover that transaction. Now, there's pluses, there's pros and cons to margin. I'm not going to go into. Just understand that when you use margin, a lot of people use margin as leverage. And when you use leverage like that, that margin, you can actually generate better returns than you would normally generate if you had the cash. And that's just because you're using someone else's money to generate the returns. If the trade works out, you don't have to pay them anything for that margin, and you get to keep all the returns. Just understand, whenever leverage is concerned, it's leveraged both ways. It's leveraged on the profit side. It also means it's leveraged on the downside. So just for example, if your leverage was 25%, let's say, so let's say you sold a put option and your normal return on investment would be 4 or 5%, but you use margin to leverage that, and now your return on that profit is going to be, or your return on your investment is going to be 20%. Just understand the reverse is true. Normally you would lose 4% and now you can lose up to 20%. So just keep that in mind. So that's what margin has to do with. So let's jump into, that's just a real quick synopsis of how a put strategy. I kind of covered some of the basics of options and between the option buying and selling. But now let's jump over to my platform and actually take a look at some trades. And then, like I said, stick with me to the end, and I'm going to give you a bonus of what I use in the place of this strategy, risking a fraction of the amount you will with put option strategies. All right, so let's go jump into my platform now. Okay, so as I said in the video, I'm going to use Apple as my guinea pig to kind of show you guys this. So actually, let me make this bigger so you guys can kind of see this. Okay, so one of the first questions that we talked about when we were looking at how selling put options work was, what's the most opportune time to sell a put option? So this has to do with, okay, if we're using put options as income and we don't want to own the stock, right? So the best time, if we're obligated to buy the stock we used Apple, I think I used a 115 example, right? So Apple's trading at 114.09. So if I sell an Apple put at 115, I'm obligated to buy Apple at $115. I'm doing this strategy to generate income. So the best time would be when I wouldn't be obligated. So if you understand the option basics, then you would know that the best time to sell a put is in an up market, right? Now, if you don't know that, and that's the option basics, then that's why I said at the end of this video, I'm going to give you some links actually in the bottom that will teach you option basics. But at the end of the video, I'll talk a little bit more about that. But that would be what you'd want to do. You'd want to take an option basics course so you understand the basics of options. So assuming you know that, obviously, then you would look at this and you'd say, okay, so the best time that I want to be trading Apple puts for income is when Apple is trending up, because I'm least likely to be assigned or having to buy back the option at a loss. Now, a real quick caveat. In all the trading I do, now I've been trading options since about late 2012. And ever since I tied into my mentor, Travis, I've been successful at trading options. I've never lost money trading options. I did in the beginning, but I paper traded. So you can see my platform here, a real quick plug on that. You see how it says simulated trading? This is how I learned options trading. Don't learn with your real money. There is no need to do that. So anyway, let's go back to it. So you can see no stock continually goes up. It always has little pullbacks. So you can see here, there was a pullback here, there was a pullback here, a bigger pullback here, and then most recently, a big correction, just like the general market. So you're not always going to have winning trades. You're going to have losing trades. This is why I said you have to focus on risk. And a lot of videos out there, like I said, I don't want to critique or criticize other videos, but they don't show you this. And I want to show you this. So in most cases, when you're selling an option, the best time to sell an option, or the time frame that you would look at, is a shorter time frame. And the reason is because it's what's called time decay, or extrinsic value. An option's price starts to dwindle down in value, especially in the last 30 days of its options life. I just gave you a bonus tip there that we teach our students in the Success Academy, but that's really the reality. So you'd really want to focus on shorter term options. Now understand, shorter term options are going to give you shorter or smaller income potential, right? So if we look at, let's focus on the 115, 475 for a 17-day option, and then if we go to the 24-day option, 560. So you can see how the premium goes up, and that's because of that time value. The time value changed. And if you look at, you can do this in your broker's platform. You can look at intrinsic, extrinsic, and you can see the time value on this one has $4.95. And if we go back to the 17 October, you can see the time value on the 115 only has $4.10. So 76 or 66 cents less. So that's basically how, when you're implementing this strategy, you would want to pick a shorter term option. Okay, so now let's really get into the nuts and bolts of the risk, because that's what you want to focus on. So here, if we were, let's say you want to do the 114 option, okay, because Apple's trading at 114.09 and you have a strong sense that Apple's going to continue going up. So you sell this 114 put option. And you can see here, we sold the 114.16 October 20 put option. I always, another bonus tip for you, I always go to the mid price. The mid price is usually the price between the bid and the ask. So this is the most important screen that you need to focus on. And I don't want you to focus on max profit. We'll talk about that. I want you to focus on max loss. Now, the probability of max loss here is very slim, because max loss would mean that you had to buy Apple at 114 and then Apple went out of business. I don't think that's going to happen in the next 17 days, right? I know Apple very well, and I can't say with a certainty. I don't know everything about Apple, but there's a good chance that won't happen, right? But it's something you have to keep in mind. And the other thing I want you to look at is you are risking $10,000 or $11,000 to make 430. Now, before I just kind of discount everything, let's pull out a calculator here real quick, because this actually isn't bad if in the grand scheme of things. Because if you make $430 risking, I'm going to just use even numbers here, round numbers. In 17 days, you're going to generate, if this trade works out, you're going to generate a 3.91% return on your investment. That is fantastic, because if you think about that, that's in 17 days. So realistically, if you did that twice a month, right? So if we did that times 2, that's 7.82% times 12. And this is where all these guys show you videos saying 121% return on my investment, annual return, selling put options. And you can see how they get there. But this is assuming every single trade is going to be a winner. And I'm sorry, every single trade is not going to be a winner. It's just not possible. I shouldn't say it's not possible, but I've never done it, and I've never seen anyone else do it. My mentor has been trading for well over 20 years, and he never has had a year where every single trade was a winning trade. So, but the whole point of this video was to just kind of show you that risk. That's the risk you're taking. Sure, you can go out and do an out of the money. A lot of investors do that. They'll do this out of the money, and to get the same kind of income, they'll sell a couple contracts, right? So now we're back up to our 432 income level, but look at our risk, $21,318. And when I say risk, that means, hey, I got news for you. If you've got a $5,000 account, if this trade goes bad and you're exercised, you've got $15,000 in margin. Okay, and that means $15,000 at the current rate. I think TD Ameritrade charges 4.8% interest. So you need to be cognizant of that. That's your risk. You're risking $21,000. Apple probably won't go bankrupt in the next 17 days. But understand, Apple can drop in price in a heartbeat. If you don't think I'm right, well, in one day, so on this day it was at 137.98, and 2 days later it was at 120. So what's that? That's let's see, 137.98 minus 120. What was it? Let's get the real number. 121.69. 1629 divided by 137.98. Oh, so in just one day it dropped 12%. So 11.81%. So if you don't think Apple can drop in a short amount of time into where you're going to be exercised, think again. It can do it, and it will do it at times. All the time, no, but that's what can happen. So the whole point of that was to just show you that's the risk. Sell this option, sell that option. It doesn't matter. You're on the hook to buy Apple at 111.25. That's basically what's going to happen. Okay, so understand your risks. Get to know the basics of options, and then you can trade this. We do teach our members how to trade cash secured puts. We call them cash secured puts because they have the cash in the account to cover it. We do teach this, but we teach a little different twist to it that ensures their transaction. So I'm not going to share that with you, because if you want to learn that, that's what the Success Academy or Market Club Options is for. I'll talk about that at the end. All right, so I'm going way too long. So now I told you I'd give you a alternative to this with a minimal amount of risk, and that's called a vertical credit spread. If you've never heard of a vertical credit spread, this is something that you definitely want to learn, because you can see. So let's go to the 23 October. Let's trade this 114, 115 option here, and you can see I am going to risk $48 to make 52. Now I know the first thing you're probably saying is, well, $52 was the profit on the put, it's 500. Yeah, you're absolutely right. That's okay. Just change the amount of contracts. Okay, so you want to equal that same put income? There you go. We'll sell 10 of these. There we go. I've equaled the same amount, but look at my risk, $480. That means if this trade goes against me and I let it go all the way to expiration, my max loss is $480. I never have to come up with any kind of margin. If I have a $5,000 account, I can trade this. Why? Because $480. I wouldn't suggest it. I always suggest people start with $10,000, but if you had a $5,000, you could do this easily, right? If you had a $5,000 and you want to do the puts, you can. So, but you can see the income's the same, risking a fraction. Now, if we use that same calculator, right, we made 520 and we only risked 480. So what's our return on investment? Because the investment was 480. Our return on investment is 108% if the trade works out. If the trade doesn't work out, okay, let's say we had an $11,000 account. Oops, sorry about that. 11,000 minus 480, we still have 10,520 to work with, 96.80. So the vertical credit spread is by far a better strategy. If you're going to sell, if you're thinking about selling cash secured puts or selling puts as an income strategy, I highly suggest you do some research into learning how to do vertical credit spreads, because it's a much better strategy with minimal risk. Okay, the last thing I wanted to cover for you guys was the Market Club Options Blueprint. Market Club Options is a service that we use to help us get in and out of trades, but Travis, my mentor, trader, he's known as Trader Travis. His name is Travis Wilkerson. He runs the Option Profit Formula Success Academy, where I'm a co-trainer, and he has that academy is closed right now. It's going to open back up in 2021 with some new. It's basically a whole new platform, which we're very excited about. But in the meantime, we still have the Market Club Options Blueprint or the Market Club Options course. And this is what I was talking about, Option Basics Boot Camp. If you've never learned the basics of options, this is free right now, and I'm going to leave a link below. You can get into this. You get his Options 101 ebook. I got news for you. This is how I started. It wasn't through Market Club. It was through a site called Udemy at the time, or Udemy, I think it's called. That's how I got started, but it's basically this blueprint, this options blueprint. And you can't go wrong. So this will teach you his Market Club strategy, which I use all the time successfully. Is every trade a winner? No. But my winners are, the profits on my winners outweigh the losses because I manage risk. That's what Travis teaches us, and he will teach you all that. So wanted to cover that real quick. So that's it. This video went way too long. I'll have to edit it a little bit because I wanted to be a quick tip. But that's my quick tip on selling puts and what you can do in place of it. So if by all means, you guys, last thing, if you like the video, please hit the like button, subscribe to the YouTube channel, hit the notification bell. Every time I put out a new video, you'll get a notification. Leave me comments. If you want to hear or see something else, leave me a comment. And we will see you guys in the next video. Take care.